It's been said that a joint venture is where two parties come together, one brings the experience and the other brings the money. By the end of the joint venture, they've switched places. The one with the experience ends up with the money, and the one with the money ends up with the experience.
There are two ways you can get experience in life. You can get experience personally, or you can get it secondhand. That means that you can watch other people, listen to other people, read about other people's experiences, and learn from that. And if you can learn from other people's experiences, it's been shown that you get ahead much faster in life.
In this podcast, we're going to be sharing about other people's experiences with money and interest. We believe when you have these experiences and know about them, you will be better able to grow your wealth. This is the Wealth Talks podcast.
One of our clients named John, not the John here in the studio with me, was in construction work and having a very difficult time being able to buy a new pickup truck for his construction company. It wasn't that he couldn't find the truck. It was that the interest rates that they wanted to charge him were so high that the payments were very uncomfortable and really unaffordable. Fortunately, someone came forward and loaned John the money at a lower interest rate than what he was going to be charged. And John acted very wisely. He paid that payment, paid off that pickup truck, but he also began to save money so he wasn't in that position the next time. And eventually, John was able to finance his own skid steer, and now he's financing equipment for other construction workers.
John learned to save his money in a place where it was guaranteed to grow. And then when he needed to do financing again, he could turn to his life insurance policy and borrow cash values and be able to finance the vehicle himself or the equipment that he was purchasing.
That's a beautiful story because so many people, they feel stuck wherever they are right now. In America, we're different than the old Europe in the fact that we don't have a class system. In Europe, it seems like when you're born into a class, you stay in that class in many ways. In America, we have what's called upward mobility. You can be born in one class, but you don't have to stay there. It's based on the results and how many people you've been able to serve. You can change the class, basically, that you live in. And that's basically what John did in this story. He found himself in a position that was uncomfortable to be in, where he had to pay a large amount of interest to other people, to the bank. Mm-hmm. And he said, I don't like this position. He found a way where he could pay a lower interest rate and start saving money at the same time. And now because he started saving money, he has been able to go through that upward mobility. And now he is at a level where he can help others.
And part of that was a mindset change. He had to stop just being the victim and just being the borrower. He had to start being the saver so that he could then have a resource where he could borrow. So he had to change his thinking and change his actions so that he would be in a different position the next time a financing opportunity came around. He wouldn't be paying out so much interest. He'd be able to earn more on his financing.
That's really exactly what everybody who wants to grow their wealth needs to do. We have to look at where we are right now. There's probably certain aspects of where we are that we're not fully satisfied with. We should be content with whatever we have, but we don't have to be satisfied and never try to make anything better. So if we evaluate the situation that we're in and find a way to improve it, start taking those baby steps toward making it a reality.
I was doing some reading the other day, and I was really fascinated with the fact that 80% of millionaires in the United States did not inherit their money. They didn't win it in the lottery, and someone didn't give it to them. They worked for it. And the way that they work for it is they started thinking differently than everybody else around them. And I reminded of the story that Jesus talked about putting new wine in an old wineskin. He says, you don't do that because what happens is the old wineskin is all rigid and can't be flexible. And as the new wine starts to ferment, it blows the skin up, and both the wine and the skin are destroyed. He says you put new wine in a new wineskin that hasn't ever been used. It's flexible, it's still pliable, and it stretches with the new wine and becomes the shape of a container that can be used over and over again for other things. Yes. But if we don't change the way we're thinking, then we're never going to be put in a position to be responsible for more money than what we have right now.
So those millionaires who became millionaires because they earned that, they worked through it, they were self-made, they became different along the way, which gave them the ability to make that money in the first place, where someone who wins the lottery, and statistics show people who win the lottery don't keep that money, they haven't changed in their habits. They aren't able to accept, just like that old wineskin, they're not able to accept that new wine and be profitable with it. Instead, it bursts and the money is gone. And we also see this with many professional athletes. They go through all this, money that they're making, but they don't have any way to sustain it. And so many of those athletes, when they retire, and they retire very young, they're without money.
Same thing with the lottery winners, 5 years is about all the money lasts for someone that wins the lottery, except if someone's very unique and different than the majority of people that win lottery funds.
Yeah. Money is not going to make you happy, but everybody seems to want to find out for themselves. I was recently reading a book. It's a great book, by the way. It's Oh, Money, Money by Eleanor Porter. It's a novel. And in this novel, this eccentric millionaire wants to leave an inheritance, and he thinks he might leave it to his family who lives back east, but he wants to get to know the family to make sure that they would use the money wisely. So he goes back and under disguise, and he ends up willing them $100,000 to each family. Once they have this new money come in, it's kind of like the lottery winners that you were just talking about. They don't know what to do with it.
Oh, but
or some of them do.
Yeah, they have all kinds of things to do.
Or they have all kinds of things. Different people respond differently. And the lesson of the story is that more money just made them more of what they already were. And there's a good line in the book that says the only thing money is good for is to exchange it for something you want. That's true.
Yeah, money is a medium of exchange. That's its official definition. But if we just hoard money someplace, hoping that we'll never run out sometime, we become like Howard Hughes. We end up leaving it all. And the issue is how do we store money so that we have it when we need it, but it doesn't lose its value while we're storing it?
The interest rate isn't always the point to focus on. You mentioned John earlier in the show where he had a truck at a high interest rate. He wanted to be able to save some of that interest. That was a pain point. Sometimes it's cash flow that we have to look at. There's a guy that we know in the local community who recently wrecked his truck. He needed to get a new truck. He went down shopping for a new truck, found the payment was going to be $1,400 a month for 7 years. Now, we know the type of truck he was looking at, and we think the interest rate might have been pretty high on that. But the thing didn't seem to be about the interest rate for Jay. It was about cash flow. $1,400 a month was going to be tough on cash flow. So he said, do I really need a new truck? He went shopping for a used truck and found out that he could make the payment on a used truck that would work just fine for what he needed. That would only be $380 a month. So he's basically saving $1,000 a month by going with the used truck option. That's valuable cash flow that can be used to build wealth in other areas.
I think of the story of the minas in Luke 19, where Jesus is telling the story about a nobleman that inherited a kingdom, and he gave money, about 10 years worth of wages, to different people in his kingdom. And he said, do business with this. I'm going to go away, and when I come back, you're going to give an account of yourself. And when he came back, the first one had added 10 more years of wages to the 10 that had been given to him. And another one had added 5 more years of wages to the 10 that had been given to him. And the last one came forward and he said, I was afraid. And so I buried your wages that you gave me in the ground. Here's your money back. And the nobleman was furious. He said, you are going to be judged by your own words. You were afraid. And so you didn't even do the least thing you could have done and put my money on loan with the bankers so that it would have earned interest for me while I was gone. And sometimes people don't move forward and manage the money that they've been given because they're afraid. Mm-hmm. They're afraid that tomorrow the market might collapse, or they're afraid that they might not succeed if they do something, or they're afraid that they're going to lose it and then they won't have any. And we can't act out of fear. We have to act out of faith. And that's what Rabbi Lapin says business is all about. Business and faith, businessman and faith are the same word in the Hebrew language. We all act out of faith thinking that tomorrow can be better than today. And when we do that, then we get an experience. It's either a good experience or a bad experience, and we go from there and we learn to manage the money that has been given to us better.
When we get back from the break, we are going to be talking more about interest. By its very definition, the second half of this podcast is going to be more interesting. We'll be right back.
If infinite banking is a simple process, why does it seem so complicated? Could it be that infinite banking started out as something simple, but over time has morphed into a convoluted series of buying insurance policies to borrow from insurance policies so you can pay interest on your own money and somehow come out ahead? Could it be that infinite banking has been turned into a catchphrase and is marketed to seem exclusive, something for just the super wealthy or financially savvy? We think the answers to both of these questions are yes, so that's why we're holding a seminar called Infinite Banking Made Simple. This seminar will give you everything you need to know about infinite banking, what it is, and how it works. No mind-bending magic, no number gymnastics, just infinite banking made simple. If you're new to infinite banking, if you're somewhat familiar with infinite banking, or if you've known about infinite banking for a long time, this is the seminar for you. We will be covering infinite banking, what it is, how it works, and how to use it in your life. The seminar is scheduled for May 2nd and 3rd. That's a Friday and Saturday in Indianapolis. Make sure you schedule that time on your calendar now because, as you know, life finds a way to fill up even the most important dates. May 2nd and 3rd. Registration details are on the website linked here and in the description box below. May 2nd and 3rd, Indianapolis. We want to see you there.
A driver was pulled over for driving while under the influence and was given a citation and had to appear before the judge. After listening to the case, the judge says, okay, you want $10,000 or 6 months in jail. And after thinking about it, the fellow who had the DUI said, I think I'll take the $10,000. Either this fellow had a great presence of mind or he was absolutely clueless.
When it comes to interest and money, it seems like there are two camps of people. You have one camp who understands interest and how to use it to their advantage, and you have another camp who seems clueless about interest and how much they're paying for it.
I had someone call me from Hawaii. He was working a job, but he had also invested in real estate because, as you know, everyone makes a lot of money in real estate. That's what he thought. So he had invested in several properties, only he had invested on them with a credit card. He had quite the credit card debt. We discussed that. We also discussed his properties and what kind of cash flow he had. It turns out he had negative cash flow. The cash flow he was getting for the real estate didn't even cover the payments due on his credit card. And I'm talking about the minimum payments. When I pointed this out to him, he said, well, that's your perspective. I just want to say, that wasn't a case of perspective, not at all. It was a fact. When we talk about perspective, it's like when we sit around our breakfast table and we're looking out the window. I kind of sit in front of the center window. You sit off to the side of our bay window, and you'll be excitedly pointing out the cardinal that's eating at our feeder. And I'll say, where? Because from my perspective, I cannot see it. But if I talk about the squirrel off in the woods, you don't see it from where you sit. Your perspective doesn't show that. When I pointed the credit card debt out to him. You know, his minimum payments couldn't even be paid by the positive cash flow from the property. That was not perspective. That was just a fact. And he had invested in these properties thinking he was going to make all this money, but he was actually going into a hole because he didn't have positive cash flow.
That story sometimes makes me chuckle, but really it's tragic. This guy would fall into the clueless camp.
Yes.
He does not understand how the interest is working against him. He thinks he's doing something with it. He's heard about real estate, and yet he is totally off target. On the other hand of the spectrum, we have this millionaire who walked into a bank in Manhattan. He said, I'm going to Europe for a month and I need $100,000. The banker said, well, you don't have a record with this bank, so I'm going to need some collateral. He said, no problem. Here's the keys to my Rolls Royce. It's downstairs in the, out in the parking area. And he said, well, that should be more than sufficient collateral. Here's your $100,000 loan. It's going to be 6% interest. And I'm going to drive your car down into the bank vault under the street. The millionaire takes the $100,000 loan and he goes to Europe for a month. He comes back and he pays the loan off with $100,500. And the banker says, while you've been gone, I've been a little bit puzzled as to why you needed a loan for $100,000. Hey, I've been looking you up and you seem to have plenty of assets. Why did you need this loan? And the millionaire said, where else in New York City could I park my Rolls Royce in the safety of the bank vault for only $500?
Now that was perspective.
He understood how interest worked. He probably didn't need the $100,000 loan, but at 6%, the interest on that for a month is only $500. So that's a great deal for the millionaire. And he understood how that worked.
That's a great example of using interest in your favor to accomplish a goal that you have. But many people are paying interest that's not in their favor and hurting them. So there's a difference between saving and earning interest and paying interest.
Oh, yes. There's a big difference.
A lot of people want to start talking about compound and simple interest and as if they understand it completely. And most people will say, well, if you're earning compound interest, that's the best. Or if you're paying simple interest, that's the best. But what's the reality of that? How does that really pan out in the long run?
Let's say that you have a $10,000 loan and you have simple interest at 5% on that for 1 year. Well, that's going to be $10,500. Now, if you have 5% compounding monthly, then that's actually going to be $10,511.62 when you pay that off at the end of the year. Because every month, the interest for the previous months gets added to the loan balance, and the next month, you're paying interest on the interest. And so that adds up to the extra $11.62. That's a simple example of the difference between simple and compound interest.
But if someone was making monthly payments on that compound interest versus paying simple interest at the end of the year, then they would actually end up paying less than $10,500.
They would.
Because they are paying part of the principal each month and that interest isn't compounding for them anymore.
That's right.
And so we can't just say, well, simple interest is best and compound interest is the best. We've got to look at the details. We have to have the right presence of mind. We've got to think through this. We can't just be clueless.
The same cluelessness can apply on the earning side of interest as well. It can apply on the paying side of it, but also on the earning side of it. I'm thinking of this book, The Oh Money Money, that I mentioned in the first half of the show. And there's this one lady in here, when she receives the inheritance of $100,000, she gets fascinated by how interest can make the money grow. I wrote down this little quote out of the book here because it's so funny. She said, when she understood the matter, she was for investing every cent where it would draw the largest interest possible. She had never before known very much about interest, and it fascinated her with the delightful possibilities. This lady, her name was Jane, she ended up investing a lot of this money in a mining stock, thinking it was going to earn a large amount of interest. Instead, she lost a boatload of money. She ended up losing her principal.
That book is so good. I think everyone should read it at some time, maybe more than once in life, because it's just common sense about money, which isn't too common anymore.
In the example of simple interest versus compound interest that we just looked at, it didn't seem like there was a lot of difference between the two. You had $11.62. That was because we had a loan for a very short period of time and a relatively low interest rate. But banks, they make money on the volume of interest that is paid. So you have a 5% loan rate. That might not seem like very much in the first year, but when you spread it out over a longer period of time, it suddenly starts adding up to a lot more interest. For example, here, if you have a car loan of $50,000, and let's say it's at 6%, so not much higher than 5%, and it's over 7 years. Well, over the course of this loan, you're going to pay back $61,356. That's $11,356 more than your original car loan of $50,000.
And then we have Mr. Clueless that comes along, like I used to say, and I said, I'm not going to pay that extra $11,356. I'm going to pay cash for this. And because I give up the interest, compounding interest that my savings was earning, that $50,000, I end up paying $312 more than you do, John, if you financed the car and paid $61,356 for it.
Now, how can that be? Because the car loan was at 6% and your savings was only at, what did you say, 3?
At 3%. Because that $50,000, if I hadn't spent it all up front, would have turned out to be $61,668, which is more than what you paid for the car financing it through a bank.
The difference here is that this car loan is, each month you're paying some of the principal down. And so each month the 6% is compounding on a lesser and lesser balance. For the 3% that you're saving, each month that is compounding on a bigger and bigger balance. That's what makes the difference here. It's the time that's involved and it's the compounding that's involved.
Tom does a great example of this in Prescription for Wealth. You can get the book at mcpheeinsurance.com. You can get a free e-copy or you can get the audio. It's a complimentary download. You can also purchase the book, physical, comes in the mail from the store page. But in chapter 4, Tom gives an example of this, a real life example from our own finances where we thought, oh, we'll take the money out of the bank that we were saving and make a purchase. And he does an analysis and shows how we lost money doing that. Yeah, it's only a few $100s, but all those dollars, I was always told pennies make dollars, all those cents and dollars, they do add up. And that's just one snapshot, one incident. When you do that over and over in your life, it makes a huge difference.
On this particular car loan, the volume of interest was over 22%. That's how the bank is making money. The interest rate was only 6%, but the bank's making 22% on that loan.
And this takes us back to the story of the minas in Luke 19. The fellow that buried his talent in the ground, or his mina in the ground, the nobleman said, take it away from him and give it to the one who multiplied his talents and doubled them. And people said, wait a second, he already has 10 more than what he had. And the nobleman said, he who has, more will be given. He who's faithful in little will be faithful in much. And we see this example with John in our example today. He was faithful over a little bit. He became faithful over much. This is how money is made. It's not made by earning compound interest or simple interest. It's made because we put our talents to work. We put the money that we have to work, and it grows for us so that then we're able to manage more.
Interest can help in that endeavor, but you're right. It's not going to create the wealth itself.
Interest itself is neither good or bad. It's just what it is. Whether interest makes a positive or negative difference in your financial situation depends on whether you take advantage of interest or whether you let interest take advantage of you.
Interest is a reality. Sometimes you pay it, sometimes you receive it. Most likely you'll do both during your lifetime. But paying interest isn't necessarily bad when you're recovering the interest you're paying.
You can recover the cost of interest that you're paying by financing the things you buy and paying interest to yourself, or by investing in things that generate income that exceeds the interest you're paying. Next week, we're going to talk about how to recover the cost of interest with the infinite banking concept right here on Wealth Talks.